Before we get into today's episode, take a look at your screen right now, because there is some amazing which are happening right now. If you're an impact investor or working in corporate venture, specifically in sustainability or climate, I want to flag something for you. Happening just before the famous Tomorrowland Festival on July 23rd in Belgium, we're curating the investor program for Love Tomorrow. And there's a separate program at the Impact Circles Investor Lounge on Friday the 24th. It's curated, it's intimate, conversations between impact fund managers, climate LPs, and corporate venture leads. We are hosting the program. If that sounds like a room that you want to be in, I suggest you go to the show notes.
Many of these US tech companies were taking a head start over these European tech companies because there was just more money. And the returns in Europe look a little bit better. If you have less money to deploy, the process become better. But still, like, these companies were winning, and all of the companies in Europe that set out to do great were being sold. I do think it is one of the things that we truly care about, right? We also set up an office in Belgium. We're opening up maybe 2-3 more offices across Europe this year. The reason why we're doing that is we want to enable Dutch entrepreneurs and now also Belgian entrepreneurs, and there will be other countries joining, to invest in other European entrepreneurs instead of sort of being skewed into the public market where you end up investing in a magnificent seven. And Mario Draghi has done a marvelous way of putting that into a report, but I think we saw that pretty early on. In order to be more than just, as we say in Dutch, a druppel op de gloeiende plaats, and more than just like a tiny bit of impact, we thought it made sense to create scale. And what was fundamentally behind the reason of Marktlink Investment Partners and Wild Ventures merging into what is now called Marktlink Capital was the fact that we all agreed that together we could create something where 1 + 1 was more than 2. And I think that is, until this day, been the driving force. And that is what has led us, I think, to grow faster than our competitors. Hopefully, we welcome all kinds of competition, keeps us sharp. But yeah, I think that is what has been sort of the guiding principle.
Welcome to a special EUVC podcast episode. This is part of the series of episodes I love doing, which is me talking to LPs across Europe and beyond. And today we have a special guest. We have Jaap. I will not dare to say your last name, Jaap. I would make a fool out of myself. I'll let you say it next. Jaap's with Marktlink. We're going to talk a bit about Jaap's background, of course. We're going to talk a bit about the story behind the firm. Actually, this is an interesting one because there was wealth. Now it's Marktlink. We're going to talk a bit about of the whys and the hows and what that has enabled. So stay tuned if you're interested in learning from a LP that's currently allocating in venture.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Jaap, welcome to the show. How are you today?
Thanks. I'm doing wonderfully well. We just got our third daughter, so sleepless nights, but endless love.
Yeah, you're happy with your sleepless nights. You're happy with that.
Also, this will pass. No, I'm fine. Honestly, super happy.
Amazing. Congrats. 3 girls, you said.
3 girls. They're the future.
Amazing. So, Jaap, before we start, give us a quick intro. Who's Jaap? And by the way, how do you pronounce your last name? Help me out here.
So it's Jaap Vriesendorp. It's a very Dutch name, which in this context of this interview might be relevant because we're a very Dutch firm. We have one office which is in Amsterdam. But that's actually not true. We opened a second office in Belgium end of last year. But in the Dutch-speaking part, so to some extent still true. And we have a very Dutch, I would say, culture. Very direct, open, transparent. And then my last name is Vriesendorp. We'll try and practice that after the show, David.
Vriesendorp, not too bad.
Perfect.
Ik spreek een beetje Nederlands.
That actually sounds pretty good.
There you go. I'll keep that one in there, just to show off a bit. Yeah, so Jaap, tell us a bit about your background. Something you and I were just chatting casually about was this idea of why are you in venture? There's a million other things you could have done. So share with us a bit your background. Sure. And also then let's dive into that. Why venture?
I think it's a good question. I don't know if I have the perfect answer to that question. I think life also happens to you. But in some extent, you are the creator of your own destiny. And that is also partly true for me. So someone said to me, if you don't know what to do, you should join McKinsey. There's lots of folks there who don't know what to do. And that sort of stuck with me. And I spoke to the guys at McKinsey and I thought it was very interesting. And so I applied for that job and got that job. And contrary, at least to popular belief now, I actually really liked it. I think it's a phenomenal job. I don't know if I've added the most value, but I certainly enjoyed doing the job. I did mostly tech companies in the beginning, working for sort of the big tier firms in technology, the hyperscalers. And then after my MBA, pivoted and set up which was called McKinsey Fuel, the practice for startups and venture firms, basically supporting them. And I did that together with Bauke Marsman, who's now also one of my partners. And at some point, we figured out that some of these funds were doing really good returns. And we tried to chip in a little bit of our own money, and they didn't want it because we weren't big enough. And slowly, this idea of a fund of fund began to dawn on me. And that's what we've been doing for the last 5-6 years.
As an outsider, well, outsider not of the industry, but outsider to what you guys are doing on a day-to-day basis, wealth came on my radar as quite impressive, I must say. I was quite impressed, I'll be honest, because there was a lot of people in the market at the time raising. It was
2021 was a good market.
Yeah, exactly. I was going to ask you, was 21 or 22? There you go, 21, and then probably 22 was probably when I met you guys, I would guess.
That was the real start.
Yeah, exactly. But what I was impressed by was, well, here's a Dutch team, could go Europe, like that. No, nothing against Dutch, quite the opposite. My first boss was Dutch, and I loved working with Dutch people. But like, here's a European team who kind of came out the gates running. Like, your first fund was quite sizable. Like, my mind might not be serving me right, but I kind of remember first time I engaged with you guys, you had already 50 million, and there was a lot of people trying to raise at the time that weren't really succeeding, at least at that level. So I'd love to hear you talk a bit about the early days of Wealth. So at the time it was Wealth. Like, how was that, and what allowed you to be, at least in my view, successful with that fundraiser, first time fund of fund?
Thanks for the question. It's fun to do these sort of episodes because I also have to think about it myself, which triggers a lot of thoughts. Now, I think there's a couple of elements that feed into that. I think the first one was we had the idea for some time. And so when we came out, we had a good at least a good starting strategy. We had a first bunch of meetings lined up with prospective LPs. We had a couple of really good relationships from our years at McKinsey and before that in venture. And so I think it wasn't sort of starting from scratch. It was more sort of starting the engine while the car was already halfway downhill. So I think that helped. And the second thing is that whilst sort of starting this, I was reading the Dutch newspaper and I came across an article about two other guys who had started Marktlink Investment Partners. And one of the guys I knew via, and we connected. And I think from a very early point decided that we should cooperate and eventually merge the whole thing. And I think the traction that we have been able to get, fortunately, has also been for a big part, been part of that decision. And why is that the case? Because they were doing a private equity fund of fund, we were doing a venture capital fund of fund, and we found that, first of all, LPs don't want private equity or venture, they just want good returns, or they want a certain type of portfolio, but more likely than not, they want both, right? As part of their sort of estate planning or part of their wealth management. Secondly, when you're with 4 guys and soon someone else joined, it was 5 guys. It doesn't matter whether it's guys or girls, but in this case, we're all guys. You know a lot more than you know with 2 guys. So we're also smart guys. We're ex-Alpinvest people. And so I think that the level of diligence we did, the level of sort of decision-making became higher. And the third thing is when you're with 5 people, you have a bigger investor base, you can make bigger investments. And so you can hire a CFO, you can build your own KYC team to make that transition smoothly. And so you can make a little bit sort of more sort of deeper investments that go a long way that otherwise would refrain from doing because they're frankly quite expensive in these early days.
Right, for sure.
And so I think those two things, so pre-starting it at McKinsey, don't let the folks there hear it, and then teaming up with Bastiaan and Piet Hein at Marktlink Investment Partners early on, I think that really made the change to sort of coming out the gates flying.
Yeah. It's interesting because you're saying, kind of, what allowed you to do that was this ability to pitch something that wasn't just venture, right? It was just like good returns. I wonder, like, do you want to?
Hopefully.
Well, the strategy that we believe will yield good returns, right? That question being like, do you want to put some words onto like your LP profile? Like, who are you catering to? Like, who's your client? Because I think that's insightful to understand as well.
Sure. No, for sure. So I think we're unique. Unique is probably an over exaggeration of a word for asset management, but let's say we're different. I think that might be a better word in a number of ways at Marktlink Capital. And one of the ways is our LP base. And it is different in the way that I would say 90% plus of our LPs are Dutch entrepreneurs. We have over 2,500. We have over almost 3.5 billion in AUM. And all of that comes from Dutch entrepreneurs. I don't think that is sort of similar to other fund of funds in Europe who cater more to maybe institutionals or.
That's a big number, right? That's a big number.
Offices.
You skim through it, but that's a big number, right? That's a very big number coming from individuals. So it's not coming from a pension fund, or it's not coming from an endowment.
And truly, that defines also the whole DNA of this company. So the way we set it up is we started, for instance, outsourcing everything. So we did fund admin with a trusted party, and we used an investment platform of another party, and we did KYC with an agency. And little by little, we found that those platforms or those fund admins or those KYC agents, they don't scale with 2,500 LPs. So over the course of the last 5 years, we have started doing everything in-house. And so we've built our own machine. I like to say that, especially being a venture, we never set out to be a tech company. And somehow we end up being some sort of tech company ourselves, because we need to build the backbone to process all these people. And that's one thing. But the other thing is, for instance, we do 50 events a year. So we do an event every week almost, which sometimes are like very content heavy on secondaries or on the venture space or on the liquidity profile, cash flow management, tax related topics, but also sometimes just fun, right? Our flagship event is our Formula One Zandvoort event, which attracts over 2,000 people. So it's the fact that we've raised capital from Dutch entrepreneurs has determined very much the DNA of this company.
Yeah, and I guess, you know, if we go back to this topic of wealth and Marktlink, right, which now is Marktlink, you know, I guess the someone looking at it surface level would kind of look at it as a merger and then come up with all the questions that you'd have around a merger. It's a bit different, right? Because as you said, you guys were partners from the get-go. It was more like, how close are we as partners? And you just kind of deepen that partnership. But that means that from the get-go, you were catering to the same ICP in a way, right? So the Dutch entrepreneur, right, in a way. Can you kind of share a bit of what was going through your mind as you were going through these hoops of, okay, partnering with them, getting closer with them, and then eventually that leading up to this merging, right? What was going through your mind? What were some of the things that you kind of had to make sure to be comfortable, fully kind of merging, whatever that means, right? But just kind of operating under the same brand.
So there's the obvious and the non-obvious stuff, right? The obvious stuff is that it needs to click between people. The obvious stuff is that there needs to be synergies in business model. The obvious stuff is that you can make these sort of deeper investments together, and that will create sort of a better company. I think what is maybe less obvious is that we, from a very, very, very early beginning, believed and still believe that skill matters. Skill matters massively in this business. If you can write big tickets and small tickets, if you're flexible, we believe you're a winner in this space, for the simple fact that you can get the better sort of deals with the funds that you want to invest in. And so we thought that skill mattered because it would improve our business model and would improve sort of the returns we could yield for investors. But we also believed skill matters because of the sort of underlying reason why we're doing this. And the underlying reason why we're doing this, and mind you, this is 2021 or 2022, depending on how you look at it. So pre-Mario Draghi report and stuff. But we already saw at McKinsey that many of these US tech companies were taking a head start over these European tech companies because there was just more money. And the returns in Europe look a little bit better, right? Because if you have less money to deploy, the prices become better. But still, like, these companies were winning, and all of the companies in Europe that set out to do great were being sold. And so I don't know if we're as European minded as you are, David, but I mean, you named your company after it. But I do think it is one of the things that we truly care about, right? We also set up an office in Belgium. We're opening up maybe 2-3 more offices across Europe this year. The reason why we're doing that is we want to enable Dutch entrepreneurs and now also Belgian entrepreneurs, and there will be other countries joining, to invest in other European entrepreneurs instead of sort of being skewed into the public market where you end up investing in a magnificent seven. And I think that, and Mario Draghi has done a marvelous sort of way of putting that into a report, but I think we saw that pretty early on. And in order to be more than just, as we say in Dutch, a druppel op de gloeiende plaat, more than just like a tiny bit of impact, we thought it made sense to create scale. And what was fundamentally behind the reason of Marktlink Investment Partners and Wealth Ventures merging into what is now called Marktlink Capital was the fact that we all agreed that together we could create something where 1 + 1 was more than 2. And I think that is, until this day, been the driving force. And that is what has led us, I think, to grow faster than our competitors. Hopefully, we welcome all kinds of competition, keeps us sharp. But yeah, I think that is what has been sort of the guiding principle in that.
Are there any fundamental tensions that result from the fact that you're focusing on different asset classes? So like venture, private equity, growth. So an example, right? Recently we were having a conversation. I can't remember the exact context, but it was an LP asking a fund of funds a question about asset development. And the conversation revolved around a lot like, well, with venture, you're really focusing on getting these assets financed, whilst with private equity, you're focused on getting a slice of the pie, right? So there's some small details around the operating models that are different. Does it come with any downsides? Because we've talking about the upsides of you guys working together. Does it come with any downsides or with any challenges or with any nuances that maybe aren't evident?
I think it's a good question. I think where I see sort of most conflict of interest is not between people who have multiple products versus people who have one product, but between people who have products and give advice or people who have products or give advice. And so when we are competing for entrepreneurs here in the Netherlands, for instance, we don't give advice. Like, we have a product, we invest heavily into our own product. So if this product fails, it will be our money on the line as well. But we don't advise you to take the product. We will pitch to you as best as we can on the merits of the product and the merits of the team and the merits of the strategy. But it's up to you to decide whether you want to participate in that or not. And the question of whether you want to do private equity or venture or a co-investment fund, we've recently launched private credit. That is up to you. We will tell you the difference in risk, in return, in timelines and liquidity. And that is for you or your advisor to decide. I think where more problems arise is if you have the big investment banks with their private wealth departments who are advising the client on their ideal asset allocation, say, yeah, you should do 10% in venture and 20% in buyout and 40% public markets and 30% of bonds. Then it becomes tricky because they're basically not saying you should do 20% of venture, but they say you should do 20% of venture in our venture product. And then a conflict of interest starts to emerge, right? And so I think one of the other reasons we have been successful in what we do is that we keep a very sort of strict tension in that. And we say we don't give advice. We're not a family office. We're not here to advise you on how to spend your money or invest your money. That is, there is hundreds of good advisors out there. There's even more bad advisors out there. And we're happy to refer you, but that's not our job.
Yeah. There's two things I really want to ask you about, and I'm battling which one first. Let's do product first. So you spoke a lot about product now, and you kind of dropped in there. We recently launched the private credit. How do you think about your product and how it evolves over time, right? And this is a topic we don't really cover much on our podcast because most of our guests are VCs first, and then secondly, most of our LP guests are either family offices or a kind of a dedicated VC only kind of strategy. So this is actually a new topic for our audience and for myself. So how do you think about product as you grow? And I guess it's an LP informed thing, but I'd love to hear you kind of explain that a bit.
I think we've always seen ourselves as private market specialists, even if you look at sort of the early innings of this firm. And we never set out to do just venture. We always set out to do sort of a broader array of products, but always within the private market space. And I think there's a couple of sort of elements to further explore there. One is private markets is an alpha generating industry, right? You can actually have an impact, both positively and negatively. If you look at public markets, it's like everyone knows that it's better to invest passively. You can buy Vanguard and you will be better off. And not just fees wise, also just performance wise. And so why do we pick private markets? Because we believe there's sort of alpha to be made there. There's manager selection that needs to be happening. There's liquidity management. There's a whole bunch of sort of value levers you can pull. And secondly, it's always determined by the appetite of the clients, right? So we saw that there was appetite for venture. We saw that there was appetite for private equity. We now see that there's appetite for co-investment, a little bit higher risk, but also potentially higher return profile. And there is appetite to do private credit in the right way. And so that's all within the spectrum of private markets. And as you know, there is still some other stuff to discover in private markets as well. You have infrastructure, you have real estate. I don't know if we will touch upon many of those very soon, but we always set out to be sort of a private market specialist. And I think that is still, right? If you look at the Goldman Sachs family, I think it's called Eyes on the Horizon report, and you see how much is private markets, only still 30% of sort of wealth of people, right? It's not cash, it's not cash equivalents, it's not publics, it's not bonds. So I think it still is a relatively small subset of the whole pie, but a subset we like to specialize in.
This idea of doing a lot with very little people, focusing on talent, focusing on high performers, focusing on people who really know their stuff, because that creates leverage, right? We cannot not cover AI. We have to talk about it. And I don't want to do a very high level conversation. Just curious to know, like, how much are you leveraging AI? Like, how much do you think you are? Do you think you're like 80% there, 5% there, not even there, kind of wish I had more time to look into it? Have you been able to leverage it in any way already? Like, just curious to hear your thoughts.
I think when we set out on this journey, we got someone like a data scientist from McKinsey to join with us. So he left McKinsey and joined which was then called Wealth. And he built the first models, and we're using like GPT-3 back then. I think that was the version. And we're like, what is this? And we obviously used it in completely the wrong ways and made all the mix-ups that we could make. But I think we were very, very early to the game. And not just like AI, but more like data science. Questions like, how many funds if you would go into a office of a fund of funds and go to the main allocator and say, what in terms of yield is the best number of positions in a fund? How many vintage do you need to have in a fund to get the optimal spread? Is emerging managers, is that an alpha seeking strategy versus established blue chip if you can get access to the best? And how much do you overcommit? And what is your confidence level on that? I think 80% of our competitors would have a experience-based answer rather than a data-informed answer. And so I think prior to this whole AI thing blowing up, I think we were already, and we've published a lot of this research as well, and we're standing on the shoulders of giants of doing this research because a lot of good research has been done, but mostly in academia. But I think we were very sort of data heavy from the get-go. If we now like fast forward to where we are today, I don't think that there is huge progress since then. And so that makes us a little bit paranoia, but we still feel we have scoring models. We use everything that everyone else has, but I still feel that sort of the fundamentals of those initial analysis still hold. And so, yes, you can augment a investment memo by using AI, or you can have all the calls you have with GPs tracked and then like absorbed. But I think this is not an industry of millions of funds, right? This is not big data. It's like, I'll give you one example of what does work for us, which has nothing to do with AI. And that is, we send out a survey every year to all of the funds we invest in, asking them what we can do better, how they see the market, and what gets them excited. Like other managers, portfolio companies, that is where the magic sits. I think AI can help with solving the fundamental questions. I think we've gotten a fairly good estimate of the answer to those questions. I think we're still very much in the early innings of AI, and I'm very sort of excited to see what is going to happen. We use AI on a rudimentary basis in screening and drafting, but I don't think we're the front runner in saying we let all of our decisions be run by AI. That's not us. And we might be wrong. We might be wrong.
You reminded me of an actually really good podcast by someone other than us, which is really rare, I know.
I can't believe it.
A guy, it's a podcast.
Must be Harry Stebbins.
No, actually no. But it's around this topic of data science, which you mentioned is really cool. And the podcast, I'll drop it in the show notes when we publish this. But it's from David Weisberg, How I Invest with David Weisberg, and it's about super forecasting. And it's this guest, I cannot remember his name, I apologize, but he's managing like, I want to say more than 20 billion. He's a CIO managing more than 20 billion. And he's talking about using like probabilistic forecasting and this is private markets, not venture, of course, probabilistic forecasting to kind of, benchmark against like S&P 500, MSCI, et cetera, et cetera. So you made me remember that. And it's also a great listen for anyone interested in this topic. So if you enjoyed that bit by Jaap, this might also be a podcast you'll enjoy. I want to change.
Can I maybe add one thing to this?
Yeah.
You also have to remember, David, we're super boring people. So you have the actual entrepreneurs building the technology.
You're not a boring guy, Jaap. You're fun to be around.
I might not be a boring guy, but as a collective, we're boring people. We're the boring industry. So you have the tech companies, like the entrepreneurs, putting their life on the line and doing a moonshot to get to all or nothing, right? Very excited. You get the VCs who get to spend time with these amazing entrepreneurs, help them, scale them. One level of abstraction more boring, but still exciting. And then above that, you have the LPs, right? And so we're now discovering what AI can do for these companies. I think there's a lot of fluff, but still we're seeing the first maybe beliefs of what can happen on the lens of the VCs. And I think that will be like young guys doing it on their own, discovering pre-seed rounds before anyone else. And then above that, we sit. So I think there is some time for adaptation as well. I don't want to, this is not about being lazy. This is about being realistic about sort of change.
It's also
time to change.
It's also about the stakes, right? What's at stake, right? If I'm a founder building my company 2 years in, I have the liberty to do a bunch of stuff that if you're an asset manager managing, what was it, 2 point what billion, 3 point, what was it? How much you had?
3.5, something like that.
Well, there's some stuff you can't really play with. So, I think that's a big part of it as well, to be frank. I want to shift topic completely to wrap up the episode on a different topic. We spoke a lot about fundraising. We spoke a lot about the firm. We spoke a lot about kind of your beliefs as an entrepreneur building an asset management company. I want to shift to the investment side. I want to shift to the investment strategy, right? Which I know you like as well. Yeah. So guide us a bit through how does Marktlink think in terms of investing?
Yeah, so we have multiple products, right? So we have the buyout product, we have the co-investment product with private credit. But if we zoom in on venture, which I think is most sort of interesting for your audience, what we do is we make annual fund of funds. So we raise and deploy a fund of fund every year. That fund of fund has a fixed size because we believe we can create the best possible returns at that size. The fundamental strategy for that fund, which we raise annually, has three components. One, It is one fund. So we don't do a crypto fund, an emerging manager fund, a established fund. We do everything out of one fund because that creates aligned incentives and there's good money to be made in every part of that industry. The second thing is we do what some might call a vintage diversification, right? So I think one of the most underestimated risks in venture is time diversification. And I've published a lot about this. We've done a lot of research on this. When you invest actually matters. It matters much more than it matters in private equity, but it also matters much more than it matters in other asset classes. And so what we try to do is sort of time diversify in three ways. One, we do primaries and secondaries. Two, we invest over 3 vintages in principle. And 3, we invest from pre-seed to growth. So we don't do only early stage and pre-seed, we do a mix of those 3. And then the third thing which informs our strategy is that we try to do things in equal sizes. So we try to refrain from having too much conviction. So if we say we do 12 core positions, we try to write 12 tickets at the same size. And when we say we do 10 emerging positions, we try to do 10 emerging positions at the same size. It's very hard to predict, even for top quartile fund, top decile fund, that the next fund, that exact next fund will be top decile or top quartile. So we try to refrain from doing too much of that. And so that's I think, fundamentally sort of the strategy.
Yeah, it's funny that you say that. So as you know, and probably our audience knows, we do stuff on the angel side, we do stuff on the VC side, we do stuff on the LP side. And this week alone, and today is Thursday, right, of this week. This week alone, I've had a conversation with a very experienced angel, like what we like to call super angels. These are people who've been investing like for more than 5 years and have backed more than 50 companies. A very experienced investor, so was a partner at HV who's been doing it for 13 years, 13 years. And now this conversation. 3 conversations, you all said the same thing, which is ticket size is always the same. Okay. and it's so interesting, right? Every single one of these investors is saying the same thing. And of course, we're talking about venture. I won't comment anything else because I don't understand anything else. But I think it's so interesting. That's why I wanted to double click on it.
There's less reason to do it, but we still do it to some extent.
Yeah, fair enough. Yeah. My question being, very unique approach to doing the annual funds. Very interesting. Without any explanation, when he said that, like many would react and say, "Oh, what about vintage diversification?" And you went straight into it, right? You went straight into, yeah, but we do that by we do primaries, and to be fair, you can do early primaries and late primaries. We do secondaries, we do different stages, right? So there is, and our own LP tickets, right? We were able to do that. So I actually, doing it in a very informal manner, I feel like we were able to do it. So with a professional team in place, I believe you can do it even better. But still, that makes me wonder, why the annual thing? Like, what is the angle there? Why did you decide to design it like that?
So we set out on this journey to invest other people's money, but also to invest our own money. And we looked at sort of the returns in venture, and we saw that it was very skewed to a couple of years, right? And Stepstone has published a report, which is a super good report, by the way, also very good research, which basically stipulates that 80% of the returns are made in 20% of the vintages. So if you would be a Dutch entrepreneur and you would say, hey, can you invest 2 million in this fund? Can I invest 2 million with you in your 2026 venture fund? And I say, yeah, we could do that. A possibility would also be that you invest maybe 500K over the course of the next 4 years, because we all invest that way. I mean, it's all up to you. For us, there's no preference. And so what that then does is 2 things. One, ideally, it will create a more smooth return profile for the investor. So you might miss out on that one big hit vintage, but you also might miss out on that one terrible vintage. So it gives you a little bit more of a smoother ride across the venture ecosystem. I think that delivers the good return, right? Average being higher than a median, all that kind of stuff. But the second thing it does, and here we thought about also at the beginning when we started doing this, we interviewed all of the other big fund of funds and asked them what was their biggest miss, what were their biggest mistakes. And sometimes they said, we sometimes ran out of money to re-up in a really good fund and we've never gotten back to them. And so one thing that was always on the back of our minds, we should never run out of money, never run out of money, never run out of money. And if you have a lot of happy LPs that you organize a lot of events for, and where they have basically pre-committed to doing a couple of funds with you in the future, you can assert in yourself of the fact that you also have not only have money today, but you also have money tomorrow. That makes the work upfront a little bit harder, because instead of getting the 2 million at once, you get to get 4 people to do 500K, but it makes it easier in the long term. And I think that is the game we've been playing.
I guess that's also a function of your LP profile, right? Because if you were catering to a completely different LP profile, the conversation would have to be naturally different, because they just have different levers, different way to manage liquidity, different everything, right? So I guess that's one of the pros of you being so focused on one specific profile. You know them really well, you understand them really well, you can build relationships with them in a very scalable manner, blah, 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 everything you said. And then what you said is interesting, because that you're saying, well, this actually adds to my competitive edge a bit in the market. In a way.
Yeah, it's better for the investors. I am an investor myself, so it's better for me. And it's better for the GPs, because one of the fundamental problems that they're trying to solve in their head is this sustainable capital? Will these guys be around in 5 years from now? Will these guys be around 10 years from now? And we want to be a helpful LP, but at least not a harmful LP, right? And a not harmful LP is someone who runs out of money, and we should do that prudently. And so, yeah, I think it gives something of an edge.
Do no harm. Does that dynamic, like, how does that interplay with the other strategies? So that was venture, right? And I don't want to go into too much detail, but is that roughly speaking the dynamic across all the different kind of asset classes?
Yeah, so the private equity fund we also raise each year for exactly the same reasons. The co-investment fund we do every 2 years, because we basically do it ourselves, right? So it takes 2 years to deploy. And private credit is an evergreen. So it is like on a continuous basis.
Yeah, it's a different beast. Yeah,
it's a different beast altogether.
Yeah. Yep. If I'm listening in and I fit the bill of tech entrepreneur, but I'm not Dutch, can I reach out to you? Do you guys cater to non-Dutch successful tech entrepreneurs, or entrepreneurs that wanna be a part of your journey?
No, for sure. We started off Dutch. We're now also Belgian. We will open up shop in more European countries. So you're more than welcome, especially if you're European. So for sure. And also, if you are running a venture firm and you're undiscovered, or you are discovered, and you want to measure up to see where you rank highest in our models, be sure to reach out.
Do you wanna just put some words to that? So what type of VCs are you looking for? Of course, a lot of them will listen in, so it's only good to end on that note as well.
Yeah, no, for sure. So on the established side, it speaks a little bit for itself, right? So the names are more clear. We try to do the best firms in the world. Those are firms that have track record stand 20, 30 years with the same strategy, with the same team, boosting really good results. On the emerging manager side, what we did in the beginning is we looked back 20, 30 years of data and said, okay, what are the emerging managers that actually broke out to become successful established managers? And we found 3 profiles, and those are the type of profiles we're looking for in backing emerging managers. The first is what we call hyper specialists. So it's people doing one thing and one thing only. It can be in crypto, it can be in AI, it can be in anything, biotech. It's often PhD-like people, don't necessarily need to be investors, often start small in a venture partner role somewhere, and then get to the game of venture often a little bit later on, to be honest. Second thing is spin-outs. So basically people who have built a successful track record at a firm and spinning out. We also help sometimes people spin out, anchor their funds. And the third thing is sort of what we call VC disruptors. It's a little bit of a lame name for a pretty cool play. And it's basically people who are trying to do something different in venture. So trying to change the how of venture. So that can be like Seed Camp once changed the game in Europe by doing 100 tickets out of I don't know, 8 million fund.
Yeah.
That's different. And we like different. Different can be good or bad, but we like to dive deeper into what we believe.
If it works, it really works, and that's venture, right? That's exactly the point of venture.
And if you're running a portfolio play, you can try multiple things.
Yeah, there you go. That's where us people on the more LP side can be fun and less boring, right? Because
I certainly hope so.
Yeah, on that note, thank you for joining me. It was good fun. I really enjoyed the chat. Any final words for anyone listening in that enjoyed the show?
Maybe a big shout out to you. And you can either take this into recording or not. But I think you guys are doing a great job in sort of positioning European VC in the right way, and the founders and the investors and the LPs behind it. I think European VC and Europe gets a lot of shit. And that is sometimes for the right reasons. But it's also because European people are just more self-critical than US people. And so it's also often for the wrong reasons. And I like this narrative that you're shaping, which is wanted, that Europe has a lot to go for. And so I want to thank you for the time, and Andreas for the time that you put into it. We all do our part, but
Thanks, man.
I really appreciate it.
Thank you. I really appreciate it. That's really kind of you. Thank you for the kind words, man. I will definitely keep that in the recording because it strokes my ego, right?
Man, you should. Man, you should.